What's up everyone? Welcome to the channel. If you're on this video, you're looking to get in the stock market. You might already have experience, or this is your first time thinking about stocks. Well, I'm here to give you my view on investing, one that involves philosophy, patience, and risk management. There's a lot of media noise and fear-mongering when it comes to investing, and it intimidates those that have never spent time in the market. But financial independence is something everyone deserves, and it's something that I believe a lot of people can achieve in the long term if they do it the right way. The goal of this entire channel will be to provide simple education that's modern and easy to follow. No BS. How to get into stocks is the number one question that I get from friends, family, and coworkers. And before I explain it for them, I always try to start with just a simple example. Retail investors are just like retail shoppers. You have your eyes on a few things you want at the store, and you're ultimately waiting for a good discount on it. There will be some weeks where you're not going to shop, and there will be some days where you're loading your shopping cart with insane deals. That's essentially what investors are doing in the market every day, except they're buying assets that they're betting on to earn them some sort of profit in the future. Most importantly, I want to emphasize that investment itself is driven by philosophy. It's something that isn't easy, it will test your limits, and you have to build a mindset for it. Long-term investing itself is based on the fundamentals of patience. It's how winners can emerge from anywhere. We all know Warren Buffett as the most famous investor and how he's built a legacy for growth investing, but almost anyone can invest if they put their mind to it. Amazon CEO Jeff Bezos started out on Wall Street, and he moved his way up in between different firms. He eventually started his own business, tailored his market knowledge to make Amazon the ultimate consumer-driven company that it is today. Even NBA retiree Shaquille O'Neal has been investing since he's been playing basketball, and he's built major stakes in companies like Apple and Google, all the way since 2011. It's 2020 now, which means that he's nearly quadrupled his investments in just those two companies alone, within the last decade. Currently, we're going through an insane time in the market right now. Many seasoned investors have seen this picture before, while younger investors might be seeing their first market crash. The long-term economy is drastically changing towards an unforeseeable future. But one thing's for sure, and it's setting the stage for the biggest wealth transfer of the decade. This has happened many times in the past, because a stock that someone sells out of necessity becomes valuable to another investor looking for opportunity. Take a look at the three charts here, historically showing how the economy has changed till now. The S&P 500, Dow Jones, and Berkshire Hathaway are very different when it comes to what they're measuring. The S&P 500 index has measured the 500 largest companies listed on the stock exchange for years. The Dow Jones is similar, but only tracks the 30 biggest companies considered to be financially stable. Both indexes are updated over time, removing companies that don't meet the standard. They're used as metrics for analyzing the market, with the S&P 500 being considered a better indicator. Berkshire Hathaway has one of the most diversified portfolios, investing in a variety of sectors since it first IPO'd. You get the safe benefits of an index while getting huge returns from the stock as well. Like I was saying before, all three are very different, but if you look closely, you can see similar price trends across changes in time. This is because historically stock prices are determined by one thing, and one thing only: market psychology. There have been many financial crashes over time, different evolutions leading to the current market we have today. And while we've built an impressive collection of data, it's considered impossible to predict the next time a market crash happens. Unforeseen events trickling down to a single source, much like the butterfly effect, can create much bigger problems that people don't expect. Given how the year has started with the pandemic, many companies have used it as a scapegoat for addressing business slowdowns. Yes, this will of course affect companies that are directly involved with customers and supply chain, but others are simply just not being truthful. Their business models have been weakening since before the crash even started. No analyst, reporter, or economist can accurately understand the economic effects of an event until time itself has passed. If someone is trying to predict that the market has bottomed, they're only doing so based on an educated guess and maybe past data. But a big rule in investing is that past performance does not indicate future success. Murphy's Law is very real, and the worst can happen if it's possible to think about it. But the one way to protect yourself, even in a down economy, is to put your money in the hands of a company that will grow even faster coming out of a recession. I started investing in the middle of the recent bull run, which until this year had been running for 11 years. A lot had changed in the last decade. Robinhood made its revolutionary entry for commission-free trading, and it changed the game for common people to get into the market. This forced some of the biggest brokerages today to make their platforms completely free later on. Being young, I made so many mistakes in the beginning. I've had my highs and lows with investing, even though it hasn't been too long. But because of my experiences, I'm setting up some ground rules which I hope can help you too to start preparing for the future. The first rule is market patience. It's extremely important to be disciplined and set a price target for a stock you're interested in. The market moves up and down every day, and you'll feel pressured to panic buy or even sell based on price swings. But one important thing to remember, buying a stock is like buying a business. The prices will change every day based on supply and demand, but your main focus shouldn't be on the short term. It should be on your company's fundamentals and how it will grow in the future. The second rule is liquidity. This just means the available cash that you have on hand. If you have a down payment for a house, student loans, or even tied up with some sort of debt, liquidity will be very challenging. Investing itself requires money that you're willing to risk, because anything placed into the market is subject to this. For this reason, it's very important to take care of your personal finances first, before even entering the stock market. The third rule is cash being king. This is especially true during times of a potential recession. Normally, I'm not a huge fan of just holding cash. I like to diversify within stocks and my personal savings. But having cash in a serious time like this can place you at a really big advantage. Being able to buy discounted company shares and even adding more companies to diversify your overall portfolio is something that not many people are lucky to do. During the previous recession, some of the biggest companies today, like Airbnb, Slack, Square, and even Uber, were just startups back then. Their founders took these companies to where they are at today because they all had the cash to start from scratch. My fourth and final point pertains to leveraging your cash. The safest way to do this is to buy your stocks in portions. Everyone wants to buy a discounted stock now in hopes of selling it at a higher price in the future. And while that's easy to say, many people will either wait too long and miss buying opportunities, or they'll rush in too fast and overbuy with their remaining cash left. However, in a time of uncertainty, leveraging your cash over a specific time horizon is the safest thing you can do. Whether it's setting horizons by weeks, by months, or even years if you want to be that safe. It won't matter if you buy too high or low, because you're buying in portions and you can continuously smooth your cost average. There are a lot of portfolio styles out there, and they're meant for different types of investors. But it basically comes down to two things: how old you are and how much risk you're willing to take. Generally, the younger you are, the more tolerable you are for huge market swings and weathering out the storm during economic downturns. But when you're older and you're getting close to retirement, you prefer the opposite, and of course you want your investments to be much more safe and stable. Before getting involved with the market, think about the purpose behind why you're doing it. Whether you're buying for the long term or even planning to flip stocks in the short term, it's important that you build a plan, follow it, and stick to it all the way to the end. Someone that is risk averse and wants to avoid high risk can invest in mutual funds, bonds, or even ETFs. These provide steady income and grow at a general rate that doesn't significantly drop like a single stock price would. For someone that wants to take more risk, it would make sense to invest in growth stocks and balancing it out with quality dividend stocks. You're receiving quarterly dividend income just for holding a company's shares, and you have the ability to reinvest those dividends within the same company or use it elsewhere to invest in cheaper growth stocks. Being balanced, you'd want your portfolio separated across dividend stocks, growth stocks, and ETFs that all add diversification. You're a type of investor that's ready to face slow and fast turns in your overall investment journey. Personally, I'm a huge risk-taking individual, and I will never invest in mutual funds or bonds for the time being. I focus a majority of my portfolio around growth and undervalued stocks. I'm prepared to hold stocks for a majority of my lifetime. It's the reason why I started building a small position in dividend-paying stocks, and only because the prices are too good to ignore for companies that have steadily paid dividends for many years. Once you can determine what kind of investor you want to be, it gets much easier from there to invest in the market with full confidence. If there's one main takeaway that I want you to get from this video, it's that being patient will never hurt you. While one opportunity may slip, another one shows up while you're waiting. I hope to continue creating more content like this in the future and appreciate any feedback you have in the comments below. In the next video, I'll be discussing more about how to plan your stock buys in the short term and long term as well. We'll be building a portfolio tracker on Google Finance, and I'll show you step by step on how I plan and track a variety of companies that I'm interested in investing. Thank you for staying tuned to the end. You could have been anywhere on YouTube right now, but you're here watching my first video, and I give you my full appreciation for that.